muted, but I think there it is. I hear it. Okay. All right. Well, good morning, everybody. Again, for some of you, just welcome to our first virtual contracts and forms class. And so we're going to be looking at some different forms today. I thought we would try to focus on the third-party financing addendum and, of course, how to fill that out and some of the things that we need to be aware of that throw some people sometimes, and that's mostly on the second page. And then also the what we call the HOA addendum, which is the addendum for property in with mandatory membership in an owners association. But because that's so long, that's a mouthful, so we just call it the HOA addendum. And so we're going to be looking at those two documents today. Yeah, and I anticipate about 2 hours. And of course, you can come and go as you please. And if we get hung up on one and it takes longer, then just that'll be the way it is, and we'll just continue it whenever we can. So the third-party financing addendum is, if it's not the most common addendum that's used in a real estate transaction, it's pretty darn close. It might rival the HOA addendum. One of those two are probably the most common ones that we use. The majority of our properties are financed, and of course, financed from an outside party to the transaction. That's why they're called a third party. And so, where the contract is flexible, there needs to be some flexibility in the contract. This is where it really starts focusing in on the duties and responsibilities, mostly of the buyer. Because, of course, the buyer only has a certain amount of time that we'll identify here in section 2 to get approved. And we're going to also talk about the distinction between buyer approval and property approval, because a lot of people think that it has to be full approval within those number of days, which it doesn't. It's only really the buyer's part that has to be approved within a certain amount of time. So the first duties and responsibilities for the buyer: apply promptly for the financing and make every reasonable effort to obtain that approval, including but not limited to furnishing all the information and documents required by the buyer's lender. That's very intentional language, because they want to make sure that the buyer doesn't have the ability to say, "Oh, I know how I can get out of this deal. I just won't give them any of the information they need to approve me." And we get to the end of this time frame and I'm not approved, and I can jump out and say, "Oh, well, only had 15 days to get approved. I'm not going to be able to get approved in those 15 days, so I'm out, and give me my earnest money back." The lender will put a reason out there. They'll give a document that will explain the reason why the buyer didn't get approved within those number of days. And if they didn't get approved within that number of days because they didn't supply the documentation necessary, this right here would hold that buyer accountable for that. It's like, well, you're in breach of contract, because this part of the contract, the addendum's part of the contract, this part of the contract said that you would make every reasonable effort, including furnishing all the information necessary. So since you didn't do that, you're in breach of contract. You don't get your earnest money back. So this really creates a responsibility and a duty for that buyer to do everything they can to try to get approved. That pop out of getting out within a certain number of days if you don't get approved is not supposed to be just an out for the buyer. It's supposed to be a legitimate out if they really truly can't get qualified. So we sometimes this language is boilerplate language where we fill in the blanks. We understand what it says, but what it says before that is actually pretty important, because if the buyer doesn't cooperate, then the buyer could be considered to be in breach of contract, and that ability to get the earnest money back could be threatened based on not doing what they're supposed to do. So, all right. So going forward, looking at the document itself, it shows the different types of financing. Trying to find my cursor here. It shows the different types of financing that could be used in this transaction. Of course, the most common ones would be A, C, and D: conventional, FHA, and VA. Texas Vet kind of gets looked over an awful lot. It's not as easy to find, but it's a great loan if you can find it. And one of the reasons it's so hard to find is because the TVLB, the Texas Veteran Land Board, actually is kind of like the secondary market. They actually buy loans. They'll buy a conventional loan, they'll buy an FHA, and they'll buy a VA. And what they tell the lender is that they will pay more for that loan than anybody in the secondary market. They'll pay more for that loan than Fannie Mae, Freddie Mac, Ginnie Mae. They'll pay more than anybody else. So the expectation is, since the lender is going to make money on the backside of this deal when they sell the loan, that they cut some slack to the veteran, to the Texas vet, that they will give them a better rate and they will cut their fees. And cutting the fees is one of the reasons why it's so hard to find a Texas veteran program, because if they cut the fees, then you know who suffers for that? The loan officer. And so a lot of times the loan officer won't want to offer that product, but it's out there, but you've got to find it. But for the Texas vet, a lot of times the interest rate may be a half to three-quarters of a percent better, and the fees may be cut by 25 to 50%. So it is a good loan if you can find it, if they qualify as a Texas vet. It used to be a Texas vet if their point of entry or their point of exit was Texas, they were considered a Texas vet. Today they've made it easier, and I'm not 100% sure, but I think a veteran who can show 6 months of residency in the state of Texas may be considered a Texas vet. I'm not 100% sure on that. I know that rules have changed. I think that's what it is. So USDA, letter E, USDA is supposed to be used in the rural areas. It's supposed to be a low to moderate income rural real estate loan. But there are a lot of areas that you would not consider rural where USDA can still be used. So in Houston, the information that they use is census tract information in a lot of cases, census tract information from the year 2000. So we're talking about 25 years ago. And so there are places where you can still use a USDA loan that you really shouldn't be able to because it's not considered the rural areas. So an example of that, if you're familiar with Highway 290, going out Highway 290, and then there's an exit on the south, it's Fry Road. On the north, it's Cypress Rose Hill. So from that point, heading out Highway 290 and going north on Cypress Rose Hill, if you are on the north and west side of that, you can use a USDA loan still. You can use a USDA loan in Fairfield, or yeah, in Fairfield and places like that you really should not be able to, because it's the furthest thing from rural real estate, but because they're using information that's so old that you can still use it there. So anyway, so just throwing that out there. It's a great loan too, by the way. 30-year fixed, zero down, interest rate, and market rate. It's a great loan if you can get it. So there is also, you can Google it. There's an interactive website that you can go to that you can type in the address and it'll tell you whether or not it qualifies for USDA. And of course, there's a map too. And I have found the map really hard to follow, mostly because I'm colorblind, and so I know part of it is one color, part of it's another color, but I have a hard time with that. But anyway, there is that interactive website where you can type in the address. Reverse mortgages hasn't been that long where we've been able to use a reverse
On the
mortgage. Oh yeah, go ahead,
USDA,
Marty.
I would recommend if the buyers haven't, if they need a zero down program or they're looking for 100% financing, they may not qualify for. The USDA is a great program. You never know. Check the address, because I've found properties in areas that you wouldn't expect that qualified. And the rate's a little bit different, but it's 100% financing. It's an opportunity for a buyer to get into a home, and oftentimes they're very flexible versus like a VA. The appraiser and all inspections are very stringent. On a USDA, they're not. It's pretty. I've seen some houses that definitely need to work. So good call.
Yep. Yeah, I did a loan for a single mom in Fairfield about 4 years ago. And at the end of the transaction, she ended up having to come to closing with about $5. And that was about it because we were able to structure it to where the seller took care of the majority of the closing costs. And so yeah, I mean you can structure it to where, and I think maybe you know, Marty, and I can't remember for sure, but I think USDA on the seller contribution. I think it works off of the same thing that VA does, 4%. I'm not 100% sure on that. On the maximum seller contribution on a USDA, I'm not 100% sure, but I think it follows VA. I think it's 4%, but I'm not sure.
I think yeah, I'm not sure anymore either. It's been a few years since I did one, but I think it goes up as high as 6, honestly, on some of those.
Oh,
So
it's through FHA, but
yeah, yeah,
follow FHA standards.
yeah,
That's even, you know what? Now you mention that, I think you're right. I think that's right. I think
yeah.
that's right. Yep. So, and okay, so reverse mortgage, the other one, it hasn't been that long where they've been able to use a reverse mortgage. Of course, you have to be at least my age or older. Well, you can even be younger than my age and use it. 62, you have to be 62 or older to be able to use the reverse mortgage, but you can use it for a purchase these days. And then other financing, and this is the part that throws a lot of people. It's like, what else are we talking about here? Hard money. So other financing could be hard money. It's any place where we have to go to get a loan. And I know, and the reason they put it in here, I had a conversation with somebody at the Texas Real Estate Commission a couple of years back, 2 or 3 years back about this. And the reason they put that in there is because so many people doing hard money loans were calling it a cash transaction. It is not a cash transaction. If you have to borrow money, if you don't have access to the money that you're going to be using, then it's a loan. I don't care whether or not the property is being used as collateral or not, doesn't matter. A loan is a loan is a loan. It doesn't matter where its source is or anything else. So hard money, they created this G, other financing, specifically for hard money. And they even put it in the contract that it says that down payment can only be a money that you have direct access to, or that you have included that sale of other property contingency, that it's coming from there. So they really have tried to tighten up the rules on that. Hard money transactions are not cash transactions, and they should not be considered such, and they should not be written up as a cash transaction because they're not. So, all right. So, two, approval of financing. And you see here they say time is of the essence. And so, of course, whenever they stick in time is of the essence, they're saying that the time frame that you see here is the time frame. And the only way it can change is if the parties agree to it in writing. That you can't be a little bit late on this one. You know, a lot of stuff we work on is what we call reasonable time. And reasonable time just simply means that there is a time frame, but if you don't hit that time frame, that it's not necessarily the end of the world, you know, that it's not the end of the transaction, that the consequences may not be so dire. But this is saying that time is of the essence. If you don't hit that time frame and you have not changed it between the parties in writing, that there are consequences. And those consequences are immediate and they are for sure. So whenever you see time is of the essence, that means you better pay attention to those time frames. So here's where we see a lot of questions, a lot of information that is not necessarily correct, where a lot of people think things are one way where they're not. When that buyer goes to get buyer approval, where when they go to get a loan, there are actually two separate approval processes going on at the same time. There's buyer approval and there's property approval. So the buyer approval, when you think about what the lender calls the 4 C's, the things that they look at to determine whether or not the buyer is going to get their loans or not. And so the 4 C's are character, capacity, capital, collateral. The first three, capacity, character, capacity, capital have to do with what we call buyer approval. That is, how much can the buyer be qualified for based on them. The property approval has to do with the collateral. So the property is plan B for the lender. So the lender says, okay, borrower, we're going to loan you X amount of dollars based on your strength, based on your financial strength, based on your income, based on your credit, based on your assets. We're going to loan you this much money. However, before we will actually loan you that money, we're also going to check out our plan B. And our plan B is the property. And so plan B is if I loan money to an individual and they never pay me a dime back, sooner or later, the only remedy I have is to foreclose on that property. So the lender says, before we loan you, yeah, you may have that financial strength where we're willing to give you this much money, but we also need to check out the property. We need to make sure that the money that the lender, are investing in that property is recoverable. We need to make sure that if you go south on us and we don't get any money out of you, that we can take this property back, sell this property, and get our money back that way. And so, of course, property approval has to do with value, which, of course, where the appraisal comes in, has to do with clear title. That's where the title company comes in. Most likely has to do with survey to make sure that the improvements are sitting where they're supposed to be sitting because we're loaning on that, and insurability. That we need to make sure that all of those things are capable of being done on this property and that the property appraises for enough money before we invest that much money in there. And so they're going to be checking out both things. Problem that you and I run into is that because the appraisal and the survey are going to have to be paid for no matter what. Once that job is done, that appraiser is going to get paid. That surveyor is going to get paid. So the lender kind of hedges their bet a little bit and holds off on that. They hold off on ordering the appraisal. They hold off on ordering the survey until we're probably at least 2.5, maybe 3 weeks into the transaction. So the buyer has to get their approval done first. Once the lender has a pretty clear idea that the buyer is going to qualify, that's when they start concentrating on the property. That's when they're going to order the appraisal. That's when they're going to order that survey. Now, title work gets done from the very beginning because that doesn't create an additional charge. Title companies are kind of like us. A lot of times they may do a bunch of work and may end up getting absolutely nothing out of it because the deal doesn't close. Title company doesn't charge any money up front. They don't charge any money for what they do until we get to closing. So that can start from the very beginning. Insurability, same thing. We can check to make sure that a property can be insured from the very beginning because there's no charge incurred until we get to the end of the transaction. Appraisal and survey are different. We're going to have to pay for those things when they actually get done. So they hold off. I personally wish they wouldn't, because if this deal is going to fall apart based on appraisal or survey, mostly appraisal, I'd rather it happen early before I have put 2 or 2.5 or 3 weeks worth of work into this transaction. But lender doesn't care about you and I. They care about the borrower. And so they want to try to make sure that that cost is not incurred until they're pretty sure that there's actually going to be a closing. So when we look at buyer approval, we are going to put in a number of days here of how much time this buyer is going to have to walk away. This number of days here is not the number of days for approval. It actually is the number of days that they have to walk away if they can't get approval. So if they don't walk away within this number of days, they can still go ahead and continue forward, but they better get their loan, because if they don't get buyer approval, if they get past this number of days and they don't get their approval, their earnest money is at risk. So that's what that number of days actually identifies. It identifies the safety zone that I have to walk away and get my earnest money back. but it's only based on me, the buyer's qualifications. Has nothing to do with appraisal, has nothing to do with survey, has nothing to do with insurability, has nothing to do with title. If any of those things happen anywhere along the transaction, this number of days does not apply. This number of days is purely for buyer approval. And so you even see it down here. It even says what they're basing it on. They're basing on the buyer's assets, income, and credit. That's character, capacity, capital. Character, when the four C's that the lender looks at, the four C's character has to do with willingness, where the lender wants to try to determine how willing do they really truly believe this individual is going to be to pay them back. And so for the lender, they look at what has this individual done before? When they borrowed money before, did they pay it back? Did they pay it back in a timely manner? And so, of course, the thing they look at, credit history. They pull the credit report to look and see what this individual has done in the past. They have a firm belief that whatever this individual has done before may be a pretty good indication of what they're going to do now. And so they're going to pay a lot of attention to that. Now, with the understanding that there could be some mitigating circumstances, that maybe they had lost a job or been in an accident or been sick or something like that, had some family issues, whatever, that may have slowed them down for a while. And so they're going to take that into consideration. So when they look at the credit history, they figure, okay, this is a pretty good idea of what this individual is going to do. So that's the character part where they look to see what has this individual done before. And then the capacity has to do with the ability to make the monthly payments. And so, of course, that's where they look at income. They look at the individual's income to see whether or not they make enough money that the lender believes that they have the ability, the financial ability to make those monthly payments. So that's where the Fannie Mae ratios come in or FHA ratios come in. For Fannie Mae, 28% of the gross monthly income used towards the house payment. FHA, 31% of the gross monthly income going towards the house payment. And then they look at the long-term debt and all of that. So that is all tied to income. So they look at the income to help them determine capacity. Capital has to do with the financial ability to close the deal because it's not just down payment. There's also closing costs. There's also prepaids, all of those things that are also involved in closing the deal. And so that's where the assets come in. That's where they look at bank statements. That's where they look at 401k if they're borrowing against it, where they look at where's the money coming from to close this deal. So that's where you get to assets, income, credit history. That only applies to buyer approval, the buyer being able to get approved. Property, totally different. So the only real time frame that we have for property approval is down here, where if the individual is going to walk away because for some reason the property doesn't get approved, and that could be appraisal, could be title, it could be survey, could be insurability. But one of the other things we haven't quite mentioned yet, lender required repairs, which is really going to be part of the appraisal. If the appraisal I says, yeah, the value's there, you're trying to get $375,000, the value's there, but only if these things get done. Well, you know the lender is going to go along with whatever the appraiser says. The appraiser goes out to protect the lender. The appraiser doesn't go out to protect anybody else. They don't go out to protect the buyer, although the buyer may benefit from it. The appraiser goes out to protect the lender. And so if the lender sees an appraisal that says, this item needs to be done, this item needs to be done, this item needs to be done, the lender's going to most likely say, well, if the appraiser says it needs to be done, then now it's going to become a lender required repair and it's going to have to be done before we loan the money. So any of those things could knock the property out. I mean, that's 5 things there: appraisal, lender required repairs, title, survey, insurability. If any of those things get in the way, then even though the buyer may be very well qualified, then the property is not going to qualify. But there is a time frame here that if the buyer is going to walk away from any of those things, like it says, appraisal, insurability, lender required repairs, the buyer may terminate this contract on or before the third day before the closing date by giving the seller, one, the notice of termination, and two, a copy of the written statement from the lender setting forth the reason or reasons for the lender's determination. So there is a time frame here. You can't do it the day of closing, the day before closing, 2 days before closing. It says it has to be on or before the third day prior to closing. So you can't wait until the last minute to do it, because if you do, then you have not met the requirements of getting the earnest money back. So we have to make sure that that gets done. We had a transaction not too long ago where the appraisal did not come in until like 2 days prior to closing. And we had the buyer. Buyer was on our side. And when the agent called and said, well, we're going to be able to get out of this deal, I said, hold up. You've got this little issue here where it's not at least 3 days prior to closing. So I think what I would do is I would contact the other side and I would say, now that the appraisal has come in and closing is 2 days away, we're not going to make closing. We need to extend the closing. And so we did. We extended the closing. The other side did not know this document as well as we did. And so we moved the closing for about another week. That gave the buyer the ability to walk away from this deal within the 3 days. It gave them the ability to walk away and get their earnest money back. Now that's a little sneaky. I have to admit, was a little bit sneaky, but we took advantage of something that we knew about this document that the other side didn't know. They went ahead and did their extension. They went ahead and extended it. Once they extended it, then we were able to walk away and get our money back. So anyway, just throwing that out there. It pays to know your document, period. Just telling you that. All right. Number 3, security. Security just simply says that this property that we're purchasing is going to be used as the collateral. That's all it really says. If required by the buyer's lender, which I guarantee you it will be, the only time it might not be would be on a hard money loan, that each note for the financing described must be secured by vendor and deed of trust lien. So the property that's being purchased becomes a collateral. 4 is language that is required by the federal government. And if we're using an FHA or a VA loan, it is required that there be language that says that this transaction, this transaction or this buyer must be protected, where it says that if the property does not appraise for a certain amount of money, that the buyer is not obligated to continue the transaction, that they are not obligated to purchase that property. So just look at the actual language. If the financing described above involves FHA, insured, or VA financing, it is expressly agreed that notwithstanding any other provision of this contract, that the purchaser or the buyer shall not be obligated to complete the purchase of the property described herein or to incur any penalty by forfeiture of earnest money, deposits, or otherwise, unless the buyer has been given, in accordance with HUD or FHA or VA requirements, a written statement issued by the Federal Housing Commissioner, Department of Veteran Affairs, or a direct endorsement lender setting forth the appraised value of the property of not less than X amount of dollars. Typically, we see the sales price in there. Every once in a while, I see somebody put the loan amount in there. And that's not what we want. We want the actual sales price, because what is this saying? If the property does not appraise for the amount of money that is stated in that blank, the buyer is not obligated to complete the purchase. That would mean even if the seller agrees to lower the price, That buyer is not obligated to complete the transaction. Now, obviously, there really shouldn't be any reason, unless they're looking for another out, there really shouldn't be any reason why the buyer wouldn't go ahead and continue the transaction if it got dropped, but you never know for sure. But anyway, that's what that number is. It just says that. And of course, notice it doesn't give that same protection to a conventional buyer. That's why we have that other addendum called the addendum regarding the right to terminate based on lender's appraisal. That's for your conventional buyer. You can give the conventional buyer the same amount of protection. You just have to do it on a different document. The only reason it's here is because the federal government requires it. So it's here for FHA and VA because the federal government requires it. But for a conventional buyer, we have to include the other addendum, giving that buyer the same thing. A, B, and C are just a little bit additional information. Buyer shall have the privilege and option of proceeding with the consummation of the contract without regard to the amount appraised valuation or the reasonable value established by the Department of Veteran Affairs. So they're not obligated, but there's nothing to stop them from continuing to go on if they want to. Most of them wouldn't, but that language is in there as well. B says if FHA financing is involved, the appraised valuation is arrived at to determine the maximum mortgage that the Department of Housing and Urban Development will insure. HUD does not warrant the value or condition of the property. The buyer should satisfy himself or herself that the price and the condition are acceptable. In other words, HUD doesn't take any responsibility for that value that this appraiser came up with, or obviously get involved in the condition of the property. That's what they have appraisers and that's what they have inspectors for. If VA financing is involved, and if the buyer elects to complete the purchase at an amount in excess of the reasonable value established by the VA, buyer would have to pay the excess in cash from a source which the buyer agrees to disclose to the VA and which the buyer represents will not be borrowed funds except as approved by VA. In other words, these has to be funds that the veteran has access to, that they are not incurring another loan, because if they were, then of course that loan would have to be paid back and that would go against the ratios. So they want to make sure that it's money that they have available to them at that time. And then the last part of this document, number 5, authorization to release information. This section may actually be going away because this has to do with something that the CFPB came up with 10 years ago now. Yeah, 10 years ago, 2015, that they came up with about 10 years ago, where they said that the information regarding the buyer and the seller, the financial information regarding the buyer especially, is really confidential information. And you and I don't really have any reason to know anything about it. And because we're not involved in getting the loan. And so there really was no reason for you and I to have access to that information. But then they also include this little term here, closing disclosures and settlement statements. And so the CFPB decided that you and I, as agents to the buyer and or the seller, really didn't have any reason to be seeing the settlement document with the closing disclosure or the HUD-1 settlement statement, that you and I didn't really have any reason to be seeing that, which is about the dumbest thing you could ever say. Because yes, of course we did, because it was our responsibility to kind of look at that document, at that closing disclosure, or look at that HUD-1 settlement statement and see whether or not the charges were legitimate, that whether the charges were really reflecting the contract that you and I filled out. Was our buying being charged for something they shouldn't have been? Or were there charges that looked like that they shouldn't be there, or things like that? Of course, that's our responsibility to take a look at that. Well, when the CFPB passed the rule that said that you and I had no reason to see it, this authorizes that. So this kind of overrides what the CFPB came up with, that you and I really didn't have a reason to be seeing those documents, which, like I said, is about as dumb as you can get. So this was there to override that. It wasn't all that long ago that the CFPB went back and reversed themselves and said, well, I guess maybe it is appropriate for the agent to see that information. So we're going to pull that rule away. So now that they pulled that rule away, you don't really need that language anymore. And you don't really need that RESPA, TILA addendum anymore that also gives us permission to see the settlement statement, because you had to have that addendum because this may not be part of the transaction. If it's a cash deal or an assumption or something like that, or seller financing, then this provision would not be there because this document wouldn't be there. So there is an addendum for that too. So we may get rid of an addendum, and we may get rid of that language. We should be able to, but it's still there because enough lenders and title companies have been used to receiving it that they're still requiring it, even though they're not up on the rule that CFPB pulled back and said you don't really need that anymore. So anyway, all right. So that's kind of the third party financing addendum. Let me throw it out there. Anybody have any questions on any of that, or anything that you'd like to add in, or anything about this document, or questions or anything? We have
I
any?
have a question.
Yeah, sure.
So on the third party, on the buyer approval, what is the amount of days that you would put on that blank? And two, are they, I don't know if I missed this, are they supposed to give you a written document that says, hey, on the seventh day, buyer had final approval?
Yeah, I
Or
wish there was. Yeah, I wish there was, but the most of that is us just following up with the lender to ask them, do we have buyer approval? Do we have buyer approval? I wish that there was something that the lender was required to provide you in writing that said, yes, our buyer now has buyer approval, but unfortunately there's not. That would sure make our lives a lot easier, that's for sure.
so we just take their word for it, even though they're still working on it or not necessarily
Yeah,
have the final.
we have the right to believe information that comes from credible sources. The
Okay.
lender who's doing the approving should be considered a credible source. If they tell us, and I would rather get this in writing, I would rather get it
Mhm.
by email or by something like that, so I have something to fall back on too. But we have the right to believe what we're told. If they came back later on and said, "Oh, I'm sorry, I made a mistake. I thought they had buyer approval, but they really didn't," that's not going to be on us. As
Okay.
long as we're not the ones who just made that up just to try to be able to move forward. So, yeah, I wish there was something that they gave us in writing, but maybe some lenders might, but if they do, it's something that they have created internally. It's not something that's required.
Okay. And how many days, if you're representing the buyer, would it be most appropriate, I guess, to put in that blank?
It's a good question because, normally, I'll tell you what we normally see, and I'm going to say between 15 and 20, maybe 21, 15 and 21, something like that. I think when you throw in 7 days, I think you're asking for trouble. And, because they may be pre-approved, they're pre-approved a lot, most of the time before they go into it. But that doesn't mean that they're going to be able to get everything in the amount of time that they need, or they're going to be able to get that part underwritten or all of that. It needs to be an appropriate amount of time. 15 to 20, 21 days, I think is probably plenty of time. If I have a seller, a listing agent who's trying to knock that number of days down to 3 or 5 or something like that, that tells me that they're not being realistic, that they're just trying to create some kind of situation where they may be able to do an earnest money grab somewhere along the way. So, Marty, what do you think?
No, I agree. I always put 21 as well, 15, 21, based on the discussion with the lender. And it's like, where are you at? And usually a little extra times, you never know. But you want to do that. You can always get approval sooner than that, but you don't want to limit your time for your buyer to get approved, especially if they do have to shop or change loan product or whatever. And then a comment to Laura as well is On the buy side or sell side, listing agent, you have the right to call the lender and just, hey, where are we at on this? That's a part of the thing. They give you permission to contact them and say, how's the loan progressing? Are they approved? Have you ordered the appraisal? Those type of things. So I think it's good. Yep.
Yeah. Yeah. I mean, you have to remember that some of this information is coming from outside sources. You've got verification of deposit, you've got VOE, verification of employment. So, you've got to give it enough time to be able to get that stuff turned around. It may be an HR department who may not get to it for a week or, something like that. We just need to make sure that the timeline makes sense. So, yeah.
It'd be also nice to know if you're on this either side, what's your turn time for processing, what's underwriting like, do you do it in-house, out-house? Those are things, if they say, oh, I've sent several lenders, I can do it in a week. No, you can't. You do everything out, outsource your underwriting and, are they direct underwritten approval, meaning automated? Are they approved that way? Then, okay, do you have the conditions met already? Those are things you could do. But yeah, typically 21 days is pretty standard, I think.
Yeah, and that's a good point. Yeah, they may have AU, the automated underwriting, where that they are clean as a whistle and they just, fly right on through. But there could be a situation where we've got to get a human being involved to actually take a look at some of this stuff and determine, yes, they qualify. They may be able to get buyer approval. It still may not be at the best terms and conditions based on, maybe a hiccup here in the credit. And that's another thing too on buyer approval is they may want some kind of proof. It's like, tell me why was your car payment 30 days late 6 months ago? Where it's like, well, the reason was because I paid it on time. They just posted it to the wrong account. Well, I need some proof of that. And so now I've got to go to the lender and get something from them in writing stating that that's what happened. And all of that takes some time. So yeah, we just need to make sure it's an appropriate amount of time to get that done. And we may, somewhere along the way, we may even have to go and try to do an amendment and extend that if we're still not able to get it done. Now, that's not a certainty that we're going to be able to get it extended because it takes the both sides to agree to it. But we certainly don't have to extend that based on property approval. So did that help? Okay, good.
Thank you.
Yeah, sure, absolutely. Any other questions? Anything else? I was looking in the chat. I didn't see any questions. Did I miss anything in chat? So. Oh, yeah, that's a good point too. Yeah, because of COVID up to the day of closing, pulled out verification of income because yeah, they may be employed yesterday, but maybe not today. So yeah, that's a good point. You're right. Absolutely, that's true.
And I ran into, because the 21 days is really necessary, because I ran into that 2 years ago at Christmas time. I had a school teacher that they waited till the week of, and we were closing 2 days before Christmas. They waited till the week of then to verify employment. Well, nobody was there. We couldn't close till after the holidays. And it was a sad situation for the little couple. But if we hadn't had those days to cover us, we could have been screwed on that one.
Yeah, absolutely. Yeah, time of year can have an effect on it. And remember, these are calendar days, not business days. So definitely every day counts.
So Don, touch on this. This has happened to every agent out there who's been in business more than a couple of years. Is the credit docs and income docs are no good, no longer than 60 days. So they're oftentimes pulling credit again, or they're pulling employment docs or credit docs right before closing. And oftentimes a buyer will go out and get credit prior to closing, and oftentimes they're close on ratios. So I've had several deals ruined at the last moment because the buyer thought they needed a Home Depot credit line. So,
yeah, yeah, absolutely. He's right. Yeah, that's and I know a lot of lenders put out this list now of, do's and don'ts. And one of the big don'ts is don't go spend any money. Don't buy anything on credit during that time. But you're right. I'm going through that right now where a transaction that I'm actually working on, where it took a while to get some foundation work done. And so we're 60 days down the road from when the original approval was done. So they went back and re-verified everything. They went back and pulled credit again. They had to re-verify employment. They had to re-verify, pull new bank statements and all of that. Luckily, we had had that conversation, and he wasn't going to do it anyway, I don't think. I think he knew enough, but you can never assume that. You know what they say about assuming, right? You don't you don't want to get caught in that. So that he didn't go out and make any credit purchases. But yeah, absolutely. You can't assume at the very end that they're not going to go back and pull. And especially if they start getting a feeling that maybe they've gone out and done something. Yeah, they may go back and pull all that stuff all over again. Good point. Thanks for bringing that up, Marty. So yeah. Anybody else? Anybody else? Anything else? No? Okay. It's very easy. It's really this part here where at least I'm seeing the biggest majority of issues where there's a concern that, hey, the appraisal hasn't come back yet. We're getting close to the number of days. Do we need to do anything? And the answer is no. The only number of days you need to concern yourself with is making sure that you've got at least 3 days to be able to walk away before the closing date in order to get that earnest money back for that buyer for property purposes. And then the number down here, making sure. And I've had sometimes, even on a conventional loan, people put numbers down here. That's not appropriate. This is obviously not for conventional financing or anything other than FHA and VA or USDA, which is kind of surprising to me since it is a government loan. Kind of surprised that USDA doesn't fall into here as well, but it actually doesn't. So other than that, that's pretty much it. All right. So if we're good with this document, then we'll go on to the HOA addendum. There's a couple of things on that too that we need to definitely take a look at. So I'm going to stop share for just a second.
Hey, Don,
Yeah.
I'm going to stop recording on this. We'll have a two separate recordings, so the first half and the second half. And once you start recording on this
Oh, okay. Thank you.